bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 25th, 2026 episode. This week, I'm joined once again by my partner, Tony Capone, and our regular audience knows just what that means. This is the latest episode in our Renewable Energy Tax Credit Finance series. Anyone who listens to Tax Credit Tuesday regularly knows Tony. He has spent decades working on renewable energy tax credit transactions, finance modeling, and tax equity structures. Probably doesn't like the fact that I emphasize decades. And he's helped countless developers, investors, and lenders navigate the constantly evolving renewable energy marketplace. Today, Tony and I are going to discuss the top renewable energy finance structures in 2026. We'll also be discussing some key financial modeling considerations for developers and sponsors who are pursuing, developing renewable energy tax credit transactions. Now, if you've been involved in the renewable energy industry for any length of time, you know that there isn't a one-size-fits-all approach when it comes to transaction structures. A lot of the other tax credits that we work with do have some pretty standard structures that are virtually one-size-fits-all. This is not that. In part, it's because developers and investors have different priorities with respect to the various tax benefits and other economic benefits of the facilities that they're seeking to develop. And not only do developers and investors have different priorities for the various sharing of the various benefits, the market itself continues to evolve. You have tax credit transferability, evolving investor demand, as well as other financing changes. As a result, sponsors are typically reviewing multiple structure options simultaneously and trying to determine which one delivers the best combination of economics, flexibility, and long-term value. Given all of that, today, Tony and I are going to discuss the most common structures currently being used, how sponsors or developers should think about evaluating those structures, and why a robust financial model is often one of the most important tools to ensure a sponsor developer is making the right decision. Tony and I have a lot to cover today, so if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday. It's always great to have you on the podcast. Now, before we dive deep into today's topic, those in our audience who may be hearing for the first time, which is probably not very many, do briefly describe some of the many services you provide to Novogradac clients.
Great. Thanks, Mike. Glad to be back. All right. So as most folks know, I oversee 3 silos of services, transaction advisory services being silo number 1. That's what we're going to talk about mostly today. Silo 2 would be financial statement audit related services. And silo 3 would be preparing tax returns. And so again, today we're going to focus more on transaction advisory services, financial modeling, and consulting clients on how to evaluate various structure options.
Great. Thank you for that, Tony. Now, when I think of the various structure options, I think of them being established to help allocate among the parties to the transaction of 3 primary economic benefits. And those 3 primary economic benefits that I think of when I think of a renewable energy project that a developer is seeking to monetize or not, that these are the 3 major benefits that's driving them to be able to finance their development. And that, of course, is tax credits. There's also tax depreciation. It's really losses, but the losses are driven by tax depreciation in the fact that you have a lot of personal property that can be expensed and or depreciated over a short life, as well as annual cash flow. So credits, depreciation benefits, cash flow. And when I think of the various structures, that those are ways in which those benefits can be monetized and or allocated to investors versus the developer. So with that as the groundwork, if you could just list out the top 4 most commonly used structures, and then I'll want to go into each one in more detail. But if you could first just give a quick level set, here are the 4 structures that you see the most.
Great. Okay. So the structure that we see the most is the partnership flip structure. It's been around in the renewable energy industry since the industry's inception. So that's number 1. Number 2 would be a structure that we're seeing a lot more these days, but we didn't start seeing until transferability came into existence. And that structure is referred to as the quote unquote Pref-Equity structure, also known as JV structure. So that's a structure that, again, came out with transferability, still doesn't have a name that the industry is totally coalesced around. So there's an opportunity to build some consensus there, but that's how people are referring to it, as either Pref-Equity or the JV structure. That's two. The third structure is the Sale-Leaseback structure. That's a non-partnership type of structure, and it comes from the equipment sale-leaseback financing industry. So it's a little unique in that regard. And then the fourth structure has a couple names as well. I'll refer to it as inverted lease, but it's also been referred to as a lease pass-through structure. And that's a structure for our listeners who are familiar with the historic tax credit industry. That's one of the most commonly used structure in historics, but we also see it in renewable energy. And so those are the four. Again, partnership flip, Pref-Equity / JV structure, sale-leaseback, and inverted lease.
Great. Thank you for that. And we'll end up going into more detail about how you choose among the three, given the three sort of large economic assets that a facility has and generates: the tax credits, the tax depreciation, as well as the cash flow. But I will just say that if you're a sponsor of a real energy facility, you can't use the tax credits, but you can use the tax losses and the cash flow. Once again, you can't use the credits, but you can use the tax losses and you desire the cash flow. Then you could just go off and do a transfer structure and not use one of these four. Got that right?
Absolutely. Yep, you got it.
Okay. So now let's look at these four. So these four are in essence going to be used when you want to, at a minimum, monetize depreciation and or cash flow. Let's start with the partnership flip structure. Please give an overview of what the partnership flip structure is, the first and the one that you mentioned is the most common.
Great. So I'm guessing there are folks on here who are familiar with that structure, but just quickly, the partnership flip structure is, as it sounds, there's a flip. And when they say flip, what they're talking about is a flip in the profit loss sharing ratios of the partnership. So for example, let's say, Mike, it's usually a two-partner partnership where you've got a managing member partner and then an investor member. We'll refer to the investor member as Class A and we'll refer to the managing member as Class B. I'll give a hypothetical example where I'm the developer and I'm going to be the managing member / Class B. And Mike, you're going to be my investor member Class A. And we're going to create a partnership flip. The classic way you see the flip structured is whereby I, as the Class B member, come into the partnership with an initial 1% pre-flipped ownership interest in profits, losses, and cash flow and capital. Okay. And you, as my Class A investor member, you're going to come in with a 99% pre-flipped interest in profits, losses, and cash flow. And if we're talking about, say, an ITC transaction, for example, for illustrative sake, our pre-flipped interests are going to be in existence throughout the entire tax credit compliance period. So if we're talking about ITC deals, that's 5 years starting on the date the facility is placed in service, okay? Now, it doesn't have to always be exactly as I'm saying, but this is just the way you most commonly see it in the marketplace. At the end of the ITC compliance period, our partnership agreement will have language in it that says that our interest will automatically flip, whereby you, as the Class A investor member, your 99% pre-flip interest will now flip down to as low as, say, 5%. And my Class B managing member interest will automatically flip up to, say, 95%. You follow that? And in that structure, typically, once the flip happens, then I or one of my affiliates has an option, a call option, to buy out your remaining 5% interest. And that 5% interest, right? It's much lower than it was previously. And as a result, it's a lot more affordable for me to buy out a 5% interest than it is for me to buy out a 99% interest. Okay. So that's the partnership flip in a nutshell. Okay. Now I'll just add to that since transferability came into existence with the passage of the Inflation Reduction Act, you still see the flip a lot in the marketplace. However, these days, it's not uncommon for the partnership agreement to have language in it that says the parties reserve the right to make an election for the partnership to actually transfer the credits as opposed to allocate some or all of the credits. That's the flip.
Great. Thank you for that. And I will just note that some of our audience may be more familiar with the low housing tax credit. And the low housing tax credit, what's of note is that generally speaking, tax credits are allocated in accordance with the depreciation that gets allocated. And ITC is unique in that ITC is allocated based on profits. And that's why you end up with the profits interest being 99%, or one of the reasons why the profits interest is 99%, at least as long as the 5-year compliance period, depending upon other structuring factors. And there is that sort of critical difference that goes back many, many years. And we won't go into why that's the case.
Yeah.
But
And there's a few wrinkles with the flip. I talked about in the context of what we refer to as a fixed flip scenario, where at the end of the compliance period, the interest automatically flip. You can also have what's called the yield-based flip, where once you get to a certain point in time, we'll measure your yield, you being the Class A investor. We'll figure out what your IRR is up until that point in time. And the flip doesn't incur until you've achieved a minimum IRR. Okay, so you've got a yield-based flip as well. And then obviously, if this were a PTC transaction where the credits go 10 years, you wouldn't want that flip wouldn't happen until the end of the 10-year production tax credit period.
And then in terms of the option at the end of the credit recapture period, generally speaking, it's going to be fair market value option. And then many times the owner of the interest also has a below market put. Both of those terms are designed to ensure it's not a predetermined fact that the exit's going to happen one way or the other.
Exactly.
So now that's number one, the partnership flip, as you mentioned, the most common. Now, if you could explain the preferred equity structure or the JV structure.
Great. So as I said earlier, that structure didn't really exist in the renewable energy industry until transferability came out. Since then, that's a structure that we're seeing a lot more in the marketplace these days. Under that structure, you almost always see the credits transferred. Sometimes you'll see the partnership retain a small portion of the credits, but for the most part, those partnerships are selling 100% of the credits. Now, how is that structure noticeably different than the flip? Well, Mike, if you're still my Class A member, you're not coming into the partnership with a 99% interest in profits and losses and cash flow. You're coming in with something substantially less. For example, you might be coming into the partnership with, say, a 51% interest in profits, losses, and cash flow. And I'm retaining maybe upwards to, say, a 49% interest in profits, losses, and cash flow, okay? So you can see right away under that scenario, me as the sponsor, I'm going to be allocated a lot more of the depreciation benefits than I would be under the regular flip. Because in the flip, I'm only going to get, say, 1% of the tax depreciation benefits, whereas you're going to get 99. In the Pref-Equity structure, a lot more of the depreciation benefits are staying with the sponsor. And so as me as a sponsor, I'm not going to raise as much money from you under the Pref-Equity structure with respect to the depreciation benefits. Okay. As a Class A member, you're going to contribute capital to the partnership. Again, in our illustrative example, we're going to assume you're coming in for a 51% interest. Okay. So you're going to get allocated 51% of the depreciation benefits, and you're going to get allocated, in some cases, substantially all of the transfer proceeds, depending on how we finance construction. So in that Pref-Equity structure, you might be providing capital to help me pay for construction costs, which might ease my burden of having to try to find a construction lender. Okay. And so you're providing maybe some bridge financing on the tax credit transfer proceeds. Maybe you're providing some bridge financing on construction financing. And the idea is when those transfer proceeds come in, I'm going to make a distribution back to you to return a bunch of your capital. And then I'm going to make distributions of more cash flow to you as my investor member than I normally would be expected to do under the flip. And I didn't really talk about under the flip how cash flow gets shared, but with the partnership flip scenario, if you're my Class A member with the partnership flip, the cash flow you're getting usually comes in the form of what we call a priority return distribution of cash flow. If you're getting variable cash flow in addition to that, which you can and oftentimes you do, but it tends to be a relatively small portion of what's providing you your return. Whereas in the Pref-Equity structure, your share of the net operating cash flow is a much more significant driver of your return. Your return under the Pref-Equity structure is being driven in large part through a return of capital through ITC transfer proceeds and then through distributions of net operating cash flow. Okay? And a smaller portion of tax depreciation benefits than you would see with the flip. Does that make sense?
Yes, it does.
Great.
So thank you for that. The two structures we talked about so far is the facility itself, as a general rule, is being built inside a partnership. And you have these two partners, either a flip structure, the preferred equity structure. Now let's turn to the third of the four that you mentioned. That's sale-leasebacks. Please explain what a sale-leaseback is for our audience.
Great. So a sale-leaseback structure, that's a non-partnership structure. So the first two structures I've talked about are both partnerships. Now we're talking about the sale-leaseback. That's a non-partnership structure. That's probably the simplest of these four structures that we're going to talk about today. Simplest in that, again, I'm the sponsor. Now you're my investor member. With the sale-leaseback structure, I'm going to build the facility, and then I'm going to place it in service, and I'm going to sell that facility to you 100%. So you're not investing a portion of the capital, you're buying 100% of the facility from me. And then what I'm going to do is I'm going to enter into a lease arrangement with you where I have the rights to operate the facility. You follow me? And so through that, you as the investor, you own 100% of the facility. You're going to claim 100% of the credits or transfer them. You're going to claim 100% of the tax depreciation benefits. And you're going to get meaningful cash flow out of the deal. My incentive is to operate the facility efficiently in a manner where I can generate more net operating income than my periodic lease payment that I need to make back to you in exchange for the rights to operate the facility. Okay. Now that structure, it's popular with developers who value, say, ease, low complexity. It's the least complex. I have one financing party, just you. I don't have to negotiate with an investor, a lender, bring my own capital to the table. So it's one-stop shop financing. Okay. And we'll get more into pros and cons later, but there's some cons there with respect to regaining control of the facility and the cost effectiveness of that.
And then just to clarify, when you say this is a non-partnership structure, what you mean, I believe, is that your relationship with the investor isn't through a joint venture or partnership arrangement. Here, it's through sale contract and lease the property. So
it's equipment sale leaseback. It's an equipment leasing arrangement, basically. Yep.
Let's go to the fourth, and that's inverted leases. Explain what an inverted lease is.
Ooh, yeah. Explain an inverted lease without diagrams. Okay. This is a structure where sometimes the visuals really do help. Okay. So the sale leasebacks is probably the least complex structure in this mix. The inverted leases is the most complex structure on this list. With the inverted lease, it's a partnership arrangement, but you're not just using one partnership to pull off the project financing, you're using two. With the partnership flip, you use one partnership to both own and operate the facility. With the inverted lease structure, you use two partnerships. Use one partnership to own the facility, and then use a separate partnership to operate the facility. Okay. Now, what's counterintuitive here is that I said there's a partnership that owns. So most people would think, okay, it's the owner partnership that is going to report the credits, the tax credits. But that's actually not the case here with the inverted lease structure. The credits are actually going to be reported by the operator of the facility. And so with that structure, your tax equity investor is being admitted into, I'll call it the operator partnership. The operator partnership is going to generate the electricity sales. It's going to pay all the operating expenses. It's going to generate the net operating income. And then with that operating income, it's going to use most of that operating income to make a annual lease payment back to the owner entity. The owner entity is going to own the facility, generate all the tax depreciation benefits, and allocate that tax depreciation benefits off to its owners. Now, I can already tell some listeners who aren't familiar with this structure, their head might be spinning, and I don't blame them. Okay. Sometimes we describe this structure as a structure that sort of makes your hair hurt. And to complicate things a bit further, with this structure, you get two partnerships again, owner, operator. There's even an opportunity to structure this where the operator actually takes an ownership interest in the owner partnership. And under that scenario, now you have a scenario where although the operator doesn't own the facility and generate tax depreciation deductions directly on its own, it can get allocated a portion of the tax depreciation benefits from the owner entity by the operator taking some sort of ownership interest in that owner partnership. So I've probably said enough on this structure so far, but you can tell that there's a lot of complexity here. And you can just tell that there's probably a bit of a circular nature to how the economics flow between the entities.
And when I think about this structure, and as you know, quite common in the historic tax credit area, I have some great slides that I get my annual lecture at Georgetown Law that I use that build up to it so that it's not quite as overwhelming. But I would just emphasize your point that the facility itself is built in a particular partnership, and the developer controls that partnership, and that partnership builds the facility. That partnership then leases it to another partnership, and that partnership is basically leasing the facility and operating it. It's kind of like the sale-leaseback, but this other partnership is leasing the facility and operating it, making lease payments. And as a consequence, this other entity has net cash flow, whatever the operating cash flow is in excess of the lease payments it's making, and the credits can be passed through to that partnership. So it claims the credits, has the spread on the cash flow, and then the depreciation itself stays with the partnership that built it, and then enter into that prime lease with the other partnership. And as our audience can tell, it's once again another way of allocating between the tax losses, the tax credits, and the cash flow among the various parties based upon their desires.
If the tax accountants and tax attorneys could pick the structure on every deal, they would pick the inverted lease.
They would not. They would pick what's best for their clients.
All other things being equal.
Which they never are.
Right. As we'll talk about more.
So let's talk about more now. You've done a good job explaining the four structures. Now, if you could share with our audience, I'm a developer. I come in and I say, Tony, I've got this facility. I'm looking to raise capital, looking to monetize some of these economic benefits. Tell me how you work with the developer in assessing how to evaluate the various structures.
Great. So if I'm working with a developer client and they bring me a deal, we talk about those three economic drivers that are appealing to investors, right? So you talked about the credits, the depreciation benefits, and the cash flow. And so first, we'll talk about the credits. And I'll say, well, Mike, I don't know what your tax liability position is, but can you use the credits? Let's talk about how much these credits are and compare that to your tax liability and see if you could actually efficiently use those credits. Most developers don't have the sufficient tax liability to use the really high tax credits that are normally associated with these big power projects, right? And so we'll figure that out, and then we'll say, okay, great. All right, so you're not an efficient user of the credits. Now let's talk about the depreciation benefits. Well, let's talk about how much depreciation is going to get generated. And now that depreciation will be available to you to offset your income. And we'll talk about your income that you have. Again, similar to the credits, most individual taxpayers or developers that build these projects, they typically don't have the income level to efficiently use the tax losses either. Okay. And so now we've come to realize that you're not an efficient user of the credits or the losses. Now let's talk about cash flow. Most developers place a lot of value on the cash flow. They've invested money in the deal. The cash pays them their salaries, their profits, pays overhead and all these other sorts of things of the development company. And so we know that you could use the cash and you value the cash. Now what we're trying to do is figure out, okay, you want the cash, but you'd like to monetize the tax credits and the depreciation with some tax structuring vehicle. Let's talk about which of those four structures does the best job of monetizing the tax credits and tax depreciation benefits. Okay. And then we'll talk about the flip, and the flip does a really good job of monetizing the tax credits and depreciation benefits. And then we'll talk about the JV structure. The JV structure does a really good job of monetizing the credits, doesn't monetize quite as much of the tax depreciation benefits. Talk about the sale-leaseback and then the inverted lease. Now, through that discussion, you are apt to come back to me and say, well, if I want as much cash as possible and I want to monetize as much of the credits and depreciation benefits as I can, you're most likely going to come back to me and say, I like what you're saying about the flip and the inverted lease. Okay. And then from there, we'll talk about how's the investor demand, what's the pricing, what types of return requirements do they require, et cetera. Now, let's say you came back to me, you said, you can't use the credits that efficiently, but you actually can use some of the depreciation benefits, and you'd like to use some of those depreciation benefits if you can. Then I'd say, all right, well, in that case, maybe the pref equity JV structure works better for you because you've got some income that you could shelter with some of these depreciation benefits. So maybe that would be a good structure for you. Same thing with the inverted lease. Again, with that inverted lease structure, if you set up that owner level partnership, you can get some depreciation benefits there as well. So if you're a taxpayer that can actually use some of the depreciation, maybe you like the pref equity and JV structure. Maybe you like the inverted lease structure. And then we'll talk about the prevalence in the marketplace for those structures and what the investor rates of return look like there as well. Now, let's say you come to me and all of that, you'd like to monetize the credits and the depreciation, but the thing that matters the most to you is ease of execution and timing. One thing I didn't talk about with the sale-leaseback structure, the sale-leaseback structure has one really interesting attribute that none of the other structures have. With the sale-leaseback structure, let's say you're going to claim the credit and not do a transfer. If you're claiming tax credits and you don't contemplate doing a transfer, with the sale-leaseback structure, you have a 90-day window following placed in service to sell that facility to the lessor entity. With all the other structures, the only people who can claim the tax credits are whoever owns the facility on the date the facility is placed in service. Okay? The sale-leaseback structure has this really interesting benefit to it where in the tax rules, it says that you've got up until 90 days following placed in service to effectuate that sale-leaseback transaction. And so say you came to me and you said, look, I'd like to go find an investor, but I'm placing my facility in service really soon. I don't know if I've got enough time to find that investor in these other structures. Well, in that case, the sale-leaseback structure might be really appealing to you.
Excellent, excellent point. And I should note to our audience, in preparing for the podcast, Tony and I created an excellent chart that compares the four structures to these various factors. And we will include that chart in today's show notes. So I encourage you to go there. So Tony, in preparing for the podcast, you were pointing out that some clients that you work with will look at a variety of different proposals and like one part of each one.
Yeah, right.
Obviously, you can't get one part of each one, but that's a bit of a segue into, a developer can look at it and say, this is what an initial ideal structure is, but then they have to go out to the market and say, what are the investor terms for each of these four structures? And obviously, theoretically, one structure might be better for a given developer. They might have a preference, better means, but they might have a preference for a particular structure of these four. But then when they go and get competitive proposals, they might find that when they layer in the competitive proposal, what they initially thought was ideal for them isn't as ideal as one of these other proposals, given the terms of that proposal. Please help unpack what I just said. Put it on
Right. Right. Yeah. It's one thing for me to educate clients on the structure options and how they all work and help them figure out their favorite or what they prefer the most. But then you have to weigh that with how readily available are those investors for those particular structures in the marketplace and what are the return requirements? Okay. So it's not uncommon for a developer client to say, geez, based on everything you told me, I actually really do like the inverted lease structure. And there's like this tax efficiency aspect to the inverted lease structure that a lot of developers really like. And so it's not uncommon for the developers to say, based on everything you've told me, I really like the inverted lease structure. Okay, that's great. However, if there are no inverted lease investors in the marketplace right now, or if they're in extremely short supply, then they might just not be available to you. And so that's obviously incredibly relevant. And so what we're seeing in the marketplace these days is if for really big developers with lots of projects, they consider all four of these structures. And they know that they have to have working relationships with all the investors, and they try to use all of them throughout the year because they have so many projects that they're placing in service. They need to have all of these structures that they're available. Even if inverted lease is your favorite going into it, Mike, that investor might not be there for you at that time, and you might have to go and get this other structure. Or the inverted lease structures investors there, on the surface, it looks like it's your favorite, but that investor's pricing is so low because their return requirements are so high that when you get done looking at your return requirements at this as the sponsor, you thought you were going to like the inverted lease more, but based on their pricing, now all of a sudden you actually like the flip better, or you maybe like the preferred equity structure better because all things considered, your return ends up being higher under those other structures due to the inverted lease structure investor, let's say, has such a high return requirement that it digs into your return. So now you're modeling the various structure scenarios so that you can get a better understanding of how your returns look.
No, and that's why we wanted to have this podcast to help inform developers and sponsors on the benefits, running the models under the different scenarios that investors are proposing, so you know which one is best for you. And it helps also identify some of the other sort of factors, like one of the ones that you mentioned, you touched upon briefly earlier, is ease of reclaiming the property after the compliance period. And maybe you could say a bit about that under the different structures.
Right. So you got that flip scenario where in that scenario, you were the investor, I was the developer. Your interest went from 99 down to 5. The call option to buy you out at fair market value, but the fair market value is based on your 5% ownership interest, right? Now, if you were my sale-leaseback investor, you own 100% of the facility. There is no flip under the sale-leaseback structure. So now I get to the end of the 5-year recapture period. And if I want to buy the facility, I'm buying out 100% of your interest, not 5%. Okay. And so you can see how it's a lot less expensive for me to buy you out under the flip scenario than it would be the sale-leaseback. With the preferred equity structure, you usually don't see a flip under that structure. You come in, you've got a percent ownership interest in the pref-equity structure, and it never flips. So maybe it's not as costly to buy you out of the pref-equity structure as it is to buy you out of the sale-leaseback, but it's more than it costs to buy you out of the partnership flip arrangement. And then with the inverted lease, right? With the inverted lease, if you're my Class A investor in the operator partnership, there usually is a flip under that scenario. And so that kind of works. The buyout scenario under the inverted lease kind of works similar to the regular partnership flip. So I've got an option to buy you out at the lower 5% interest level.
Well, I appreciate you walking through that issue across all 4 structures, because it just highlights the fact that you might look at those 4 and say, oh, I don't want to do this structure. But when you end up saying, well, how does the upfront look relative to the back end? And how do I balance those to make as educated a decision as possible?
Yeah. And even with the sale-leaseback financing, initially I'm thinking, I really like the structure. One-stop shop financing, just one counterparty. I'm dealing with you. You're going to give me all my sale proceeds up front. But oftentimes with that structure, to make your return work favorably for you, it's going to require you to make some form of a prepaid lease payment under the lease. And sometimes that prepaid lease payment can be more than I had anticipated. And coming up with that amount of cash flow. So you give me 100% financing. Let's just assume it's $1 million, right? But now the prepaid lease payment under that lease is $200,000. So out of the $1 million, I'm giving you $200,000 right back on the front end. Okay. And so initially I thought, oh, this is great, one-stop shop financing. But then all of a sudden I'm like, all right, but it comes with a price. Okay. And I'm not saying that's always the case with the sale-leaseback arrangement, but you can see those types of situations that need to be carefully considered when evaluating your investor options.
And we don't have time to go through all the various additional factors. One that, as a tax accountant, can't help but pop to my mind, each of the 4 and the different taxable income effects it has on the developer, the timing of income taxation. And at the end of the day, sponsors are focused on net after-tax cash flow. What may generate the most cash flow on a present value basis may have sufficiently adverse tax consequences that you prefer a different option that has better tax consequences. But we could just leave it at that to say that the number of other factors that are at play. One, before I let you go, I did want you to share how the market has changed over time in terms of which structures become, to the extent certain structures become more prevalent or were created as part of recent changes of the tax code and or the broader evolution of guidance from the IRS.
Sure. And I'll just say, I'm not advocating on behalf of any one particular structure. I've seen these structures be really great solutions on lots of different projects over the year. They all provide much needed capital to the marketplace to get projects built and operating. So it really is like a facts and circumstances analysis to figure out which structure at that time works best for you. But anyway, over time, So the flip is probably, you've seen it the most over the years. There's some tax guide. One of the reasons why it's favored in many cases, there's some tax guidance that investors have taken comfort with. There's a revenue procedure out there in the marketplace that those partnership flips are usually structured around, and investors tend to like that. You've got the same thing with the inverted lease. There's sort of some tax guidance out there that investors take comfort in. So they just feel like they can structure that with some tax certainty. Sale-Leaseback, the leasing guidance has been around forever. And so there's just a lot of tax comfort there. The Pref-Equity structure, that's a new structure. Again, that came out in the renewable energy industry as a result of transferability coming into the marketplace. And so there isn't as much, let's say, precedent on that structure itself. Okay. But that's a good example of how structures have evolved. And the way the flip has evolved, you can use that structure and allocate credits and not do a transfer, or you can retain the option to transfer credits. Investors seem to really like having that option. The tax rules have evolved in the sense that since transferability came out, the transfer rules do not allow you to transfer credits if you've made a pass-through election to pass through the credits from the owner partnership to the operator partnership in, say, an inverted lease structure. And so that's been an interesting evolution of tax rules. And then less about the structures themselves, but obviously tax rules just continue to evolve. We had the Alta Wind case, that update that came out recently that is important. That's not so much a structuring issue as it is just like a tax rule update, or tax issue update, I should say. But I think transferability that came out as part of the Inflation Reduction Act, that has caused the greatest evolution of how these structures are used, for sure.
In one area that gets overlooked a lot of times when sponsors come in and meet with us for the first meeting, if they're new, or all the various state implications from state tax incentives, state conformity, and the like, other factors like state taxation or other state benefits that are available to a developer. How often do those influence the structure choices?
So, we could do a whole separate podcast on state tax considerations. Shout out to my partner, Tom Bowman, and Reza Kareem, who handle that side of the practice. But all right, so in renewable energy, I know in historic tax credits, right? State tax credits are a big part of the financing mix, which that inverted lease does a really nice job of helping to monetize both federal and state tax credits. You don't really have state tax credits in renewable energy in most of the states, like Hawaii does. They currently have a commercial tax credit for solar, which is nice. And you see some degree of state incentives, but state incentives aren't as much of a driver on the economics in a renewable energy facility like we see in affordable housing or historics and new markets, right? But there are state tax considerations, like, for example, transferability. We know for federal income tax purposes that tax transfer proceeds under Section 6418 are tax exempt, but that's not always the case at the state level. And so you have to be really careful when you do a transfer deal to make sure you understand what the state tax implications are from those transfer proceeds. Other states' incentives that do come into play, I don't think they necessarily drive the structure choice, but they're just important state tax considerations, are renewable energy certificates, or RECs. And so some states have some valuable REC incentives. It's like an operating subsidy. It's like a cash flow subsidy. But again, I don't think these necessarily drive the structure choice, except for maybe if you're in a state that has high RECs, that props up the operating cash flow, which can in turn boost the fair market value of the facility. And that might pivot you down towards, say, an inverted lease structure.
Right. Now, and that's why I went and did follow what I said I was going to do, because we talked about the income taxation to the developer on the different structures. And I went and I said, we don't have time to go through everything else. And I threw out the question, state implications, and you just pointed out, depending on where you're located, state and city, it can have some effects on which structure you choose, and not the least of which is your example about transferable credits. If the transfer credit is income in a given state, obviously that makes the transferred option under one of these less desirable. Not that it's dispositive, but it's something that needs to be considered.
Exactly.
We can close it there. Thank you, Tony, sharing your insights. I appreciate talking about partnership flips, preferred equity structures, sale-leasebacks, inverted leases, the big four, if you will, even though they're not equal, with partnership flips being the most, Ellen. I appreciate your idea of a future podcast on state and local considerations for renewable energy transactions. I look forward to that sometime down the road. Before we go to our off mic section, I did want you to to share any closing thoughts you have with respect to this topic of the four structures and share any resources that our audience might want to be turning to help learn more about this topic and or others renewable energy related.
Yeah. So we've got a Renewable Energy Tax Credit 101 webinar that you can watch on a recorded basis that goes through these structures in more detail. That's good. We touch on some of the financial modeling aspects. In November, first week in November, we're going to have our Renewable Energy Finance Conference in Washington, D.C.
That's just the first week of November. Let's say the Thursday, Friday after the fall elections.
The Thursday. And I'm going to go even further. I'm going to say the Wednesday, Thursday, Friday following elections.
Fair enough.
Okay. Because I want to give the conference is fantastic. I've been chairing that conference for probably 15 years or longer at this point. Mike does the Washington report, which is incredible, especially following an election day.
Luck report.
Best place to be. But the Wednesday, we do a full day project finance workshop where we pull up financial models and we actually go through these structures during the workshop. I love the workshop. I've been part of that for forever. And if you're new to this or you just want more insights, please go to the workshop. You sit in, you can see live how we adjust the model in Excel and all that fun stuff. So that's fantastic. And then, of course, Novogradac has a renewable energy working group, which I'm actively involved with. We don't focus on the structures quite as much, but that is an excellent consensus working group where we share knowledge and ideas and help evolve and push forward priority items in the industry. So it's a group comprised of many of the industry's foremost thought leaders.
Thank you for all of those, Tony. We'll include links to all of that you just mentioned in today's show notes. And I will encourage our audience to register early for the Renewable Energy Conference. We sell out in election years particularly. So you want to make sure you get reservations, get a room reservation and register for the conference to secure your spot. 2 years ago, I remember well, because 2 years ago we had it right after President Trump won the election and the Republicans clearly taking control of the Senate and it looked like they were taking control of the House. So there was a lot of speculation as to what could happen, not the least of which was a fear of some rollback of renewable energy incentives, which obviously happened in the One Big Bill Act. But I get off on a tangent here. All that just to be said, please register early for the Renewable Energy Conference so you can be sure to secure a spot. Thank you, Tony. I appreciate you joining us today. To our audience, I thank you for joining us today as well. And if you found today's discussion useful, please do subscribe to Tax Credit Tuesday on your favorite podcast platform. Please share the episode with colleagues, and please visit today's show notes for additional resources. Tony's contact information will be in the show notes, along with links to the additional energy tax credit resources that we have here at Novogradac. And as I say every week, if you have ideas for future podcast episodes, please send us an email at contact@novoco.com. And with that, let's turn to our off-mic section. We like to use this space to give a shout out to others working in the tax credit and tax incentive communities. It gives us an opportunity to highlight a professional worthy of recognition. And I would be remiss if I didn't point out, Tony was the one who introduced this feature to Tax Credit Tuesday. So rather than being off mic, maybe we should call it off Tony. Tony said
The play on words works better with off mic.
So Tony, who would you like to shout out?
Yeah, so today I want to shout out my fellow Novogradac Renewable Energy Transaction Advisory Partners. So just quickly, Alvin Lee, Rob Bryant, Josh Morris, Tong Tran, Tyler Gibbs, George Barlow, Stephen Tracy, and Justin Chubb Lauria, to name a few. Okay. That was a group shout out, not just an individual, but to the Renewable Energy Transaction
on the valuation side.
Thank you, David Boyster. Sorry, I meant to say David Boyster. Thank you very much.
Yeah, that's okay. I listed in front of me that I could audit.
Good. I'm glad somebody's checking me.
I echo your shout out, Tony. Thank you for joining me on the podcast today. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novaco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.